Hello out there, dividend growth stock enthusiast. It's Colby the DGI Crab coming at you with the weekly video that I do each and every Sunday, where I'm going to go over blue chip stocks that appear to be undervalued based on my own metrics. If you're new to the channel, I focus solely on 60 dividend growth stocks. I've split those 60 stocks into 4 separate categories or tiers based on the age and timeline of the investor, which I believe are the most important metrics for any dividend growth stock investor to take into consideration. Week of March 23rd, you guys, we had another kind of down week in the stock market, and that's presenting more and more buying opportunities for us. There's going to be some consistent ones that I've been preaching about for months on end now that still look cheap. Some other ones that are starting to fall more in share price that look like they're entering the buy zone again. Some others that have actually gone up in share price this week and have crept their way up out of the buy zone. So we're going to go through all of that today. Take a look at where I believe the values in this market lie for a dividend growth investor. I'm not a licensed professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. So, in case you are new, this is my personal allocation strategy. I put 50% of new money each and every week into age-appropriate ETFs. For stocks, I'm looking for the ones that are yielding 30% or more above their 4-year average yield. My top 10 favorite stocks, which is just kind of a separate list that I keep track of, if they're yielding 20% or more above the 4-year average yield, I go ahead and buy those. Now, I will remain within my tier unless there happens to be a stock in a different tier that's yielding 50% or more above the 4-year average yield. At that point in time, I want to jump all over that bargain regardless of my age. And if there's not a buyable stock within my tier, I am just going to add more to ETFs for that particular week. Not necessarily trying to time the market as much with the ETFs. Before I jump into that spreadsheet, I do just want to remind everyone, this is the S&P 500, and what I'm looking at right here is the 5-year chart. Remember, I'm going to base this off of the 4-year average yield. So something to keep in mind here is if we're going back 4 years, back to March of 2021, what you're going to find, if you were around long enough investing and you remember what 2021 was like, it was a really hot year in the stock market. There's a lot of money printing that happened. Money has to eventually go somewhere. A lot of it winds up in the stock market after a while. And you can see in 2021, the stock market just went up, 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 up. What does that mean? Well, what it means is for a lot of the stocks that this channel focuses on are stocks that are included in the S&P 500, and a lot of them were yielding pretty low by their own standards in 2021 because the prices were just so high. And the stocks that I cover on this channel are long-time dividend increasers, meaning that whether it's a hot year like 2021 or a very down year like 2022 or a meh year like 2023, these stocks just continue to increase those dividends year over year. So why I'm pointing this out is that if I'm using the 4-year data, what we're lopping off of the analysis here each and every week is another month's worth of 2021 yield data. So what that's going to mean is that our 4-year average yields across the board on a lot of these stocks are actually going to increase whether they're doing well or not, because 2021, their yields, for the most part, for the vast majority of these, were a lot lower on average than they typically were. So what that's going to mean is that as the year goes on, unless the stock market continues to go down, 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 the way that it's kind of been going this last month or so, as 2025 goes on, it may start to get a little bit harder to find a bargain value that I'm going to be looking for. And if that's the case, it's just going to be more about ETFs. So, all right, all of that aside, I'm going to start here in the spreadsheet with Tier 1, the age 18 to 30-year-old investors who are looking for not the highest starting yield, but really aggressive year-over-year dividend growth. We want 10% at minimum or better, hopefully much better cumulatively amongst this group of stocks. So that 18 to 30-year-old investor who has a lot of time in the market is going to see massive dividend snowball over the course of the long haul. Our two dogs in the market, Nike and Nordson, not only are in that green buy zone of 30% higher yield or more, but they are in that 50% range, meaning that any age investor could look upon these as a good value. Nike really surprised me. Their earnings came out, they actually weren't bad. They beat estimates for the most part, and their stock just plunged into even lower depths. It's been languishing in the 70s for like 9 months or so now. It's briefly climbed up into the 80s here and there. I would have thought that after reporting a fairly decent quarter, that Nike would have recovered a little bit, maybe gone up into the low 80s. Instead, it dropped down here into the 60s. I'm still not particularly worried about that, you guys. I'm going to keep adding Nike in my portfolio. I'm getting a yield well above 2%, more than 2.25% at 236. The 4-year average yield of 1.22, that is 93% higher than the 4-year average yield. Looks like a great deal to me. Nordson still yielding better than 1.5%. The 4-year average yield is not quite a full percent. So I'm going to take that extra 0.5% of yield all the way to the bank with a dividend king like Nordson. Last week, we looked at United Health as a stock that was getting very close to the buy zone, trading down in the 480s, and it has climbed up well above $500 this week. So if you were adding United Health last week in the 480s, nice work. Probably a good idea to hit the pause button now that it's up here comfortably above 500 and wait to accumulate more until it shows a better sign of valuation. And in the meantime, down here, Microsoft, one of my top 10 favorite dividend stocks. Microsoft, if it is yielding above the 4-year average really at all, I think this is a great move for the 18 to 30-year-old investor. Microsoft would be in my buy zone, even though it's just 4.76% higher yield than the 4-year average. For Microsoft, that's good enough for me. Tier 2, age 31 to 41-year-old investors, the starting yield with this group will be a little higher, more in the 2.5 to 3.5% range, and we still want good solid dividend growth, but realistically, we're looking more at like 7-8% year over year with this particular group. Target and Hershey, absolutely in the buy zone, not only 30% or more undervalued, but 50% or more undervalued. I'm going to be happy to continue to add these. Really have built up a nice position in Hershey, and I am not stopping. So long as the yield is this far above the 4-year average yield with Hershey, I am all in on this one. Happy to see Next Era Energy and American States Water are both still in the buy zone. Two excellent utilities, long histories of increasing the dividend. Not super exciting companies, but very much sleep well at night companies, knowing that you can buy them and the likelihood of dividend increases year over year many, many years into the future is going to be pretty strong with those two. So 4 stocks in the buy zone here for the Tier 2 investors. Not too bad. Tier 3, age 42 to 53-year-old investors. We're looking for starting yield in the 3.5 to 4% range and year-over-year dividend growth in the 5 to 7% range realistically. We've got 4 stocks in the buy zone officially, and then T. Rowe Price just on the outside looking in. I still think T. Rowe Price is probably a buy at this particular time. But if you really want to be a stickler about it and wait for T. Rowe Price to drop down to maybe 92.50 or 92.25 before you pull the trigger, that's fine because you've still got plenty of options here in the buy zone. Archer Daniels Midland continues to be massively undervalued. I do think this company long term is going to be just fine with that dividend. You can get that starting yield at 4.43%. When the 4-year average yield is 2.51%, sign me up for that. I'm getting a lot more bang for my buck with my active income that I'd be adding to Archer Daniels Midland. Hormel's just kind of been languishing around $30, give or take a buck or two week in and week out. I'm still pretty happy to add this one if I'm in Tier 3. Starting yield is pushing 4%. Hormel is a dividend king. Long track record of increasing those dividends, you guys. I wouldn't be concerned about the share price being down. Could just be a good opportunity to add a good high starting yield here. Genuine Parts Company, I do believe is a company that's being impacted by the tariffs or the talk of tariffs or the potential tariffs in the automotive industry. Yielding 3.5% or just shy of it. Genuine Parts Company, I think, is a no-brainer. Down here below $120 a share. Pepsi, one of my top 10 favorite dividend stocks, clearly in the buy zone, yielding 3.73%, 4-year average of 2.79%. Loving Pepsi still at these prices. I hope Pepsi stays down here in the 140s so I can keep adding it at this remarkable valuation. Tier 4, age 54 and older investors, we're looking for like 5 to 6% starting yield. And we still want to have good solid dividend increases, but we're not going to get high single digit increases with this group. We want like 2, 3, maybe 4% cumulatively out of the group. Still no obvious buys in this particular category. The high yield stuff has been performing extremely well for the past year, year and a half. Maybe it's because people are looking for a safe-ish place to park their money where they can generate some income off of it. There are quite a bit of baby boomers that are going into retirement, and these are the kind of stocks that people in that category at least should be gravitating towards, just more stable stuff like Realty Income or Prudential Financial, Verizon, just stuff that's going to produce a good stable income, not be overly volatile, be relatively predictable. And that I think is part of the reason why some of these higher yield stocks are doing so well. We just got a lot of people going into retirement age, and they're going to be attracted to this high yield stuff, and for good reason. All right, now the strategy for the week here would be as follows. I'll go over the ETFs here with you guys real quick. For the Tier 1 group, if I'm in Tier 1, I'm going to be putting 25% of my money each week into the S&P 500, VOO, SPY, IEVV, whichever one you like the best. I'm going to put 15% of my money into a small cap value fund. I really like VBR for that. I'll do 5% of my money into a dividend appreciation fund. VIG is my favorite one in that category. And then I do VYMI, 5% in all of the tiers across the board as my exposure to non-US stocks. I still believe this is the best ETF for non-US stocks. Check out VYMI. I've got a video on VYMI. If you want to take a look at that, I go into that in detail. Tier 2, same 4 ETFs, but I just put more emphasis on VIG in Tier 2 and a little less in S&P 500 and small cap. Tier 3, I love SCHD, VYM, and DHS for higher yielding ETFs that still offer you some good growth potential. SCHDs perform the best on the dividend, so if I was going to weight the 3, I would do the most in SCHD as of right now, but all 3 are excellent. Tier 4, SPYD would be my choice for higher yielding stocks. These are the SPYD is the 80 highest yielding stocks in the S&P 500. And then alternative high yield investments like high yield bonds, preferred shares, MLPs, covered call ETFs, DEVO, practically the original covered call strategy ETF, JEPQ for NASDAQ 100 covered call ETF, and SPY for the S&P 500 covered call ETFs. And then my stock breakdown for the week, Tier 1, I'm going to hit Nike, Nordson, and Microsoft within my own tier. I'm going to grab Pepsi, one of my top 10 favorite stocks, and I will reach up into Tier 2 for Target and Hershey, 50% or more undervalued, so I'm going to grab some of that. Same for ADM in Tier 3, or Target and Hershey in Tier 2, ADM in Tier 3, excuse me. For the Tier 2 investors, definitely hitting Target, Hershey, NextEra Energy, American States Water in my own tier, grabbing Pepsi, ADM, Nike, and Nordson to round out the undervalued stocks in the other tiers. Tier 3, Pepsi, ADM, Hormel, GPC, T. Rowe Price, Target, Hershey, and Nike, all solid values as well in the younger age tiers. So we're really getting an opportunity to spread it around to a lot of different stocks. So if I'm wrong on any of these one individual ones, it won't be the end of the world. As long as my batting average on these is pretty high, 2 out of 3, 3 out of 4, we should have some great results here with this. And then finally, I'm going to do ETF double down still with the Tier 4s. I'm not going to buy any of those high yield Tier 4 stocks until they are cheaper. So I'm going to put double the amount into the ETFs except for VYMI, I keep that at 5%, and I'm going to pick ADM as my single stock of choice for the tier 4s. That is the video this week. You guys let me know what you are buying.